I'm Yahoo Finance Executive Editor Brian Sozzi, and you're taking a look at a live shot of the opening bells on Wall Street on this Wednesday morning. Alarm company Arlo Technologies ringing the bell at the NYSE. I used to be a subscriber, had to cancel my subscription. Biotech play, Avidity Biosciences getting things popping over at the NASDAQ with its clever RNA ticker symbol. Yes, it's RNA. This is Traders Digest. More Trump tariff uproar that has sent copper prices ripping higher, and some fresh uncertainty on who will lead the post-J. Powell Federal Reserve. Now, I should mention, of course, opening bid is all about serving up investing analysis you need to know to unleash the power of your portfolio. We're digging into what's really moving stocks, giving you the unbeatable context to make decisions with all of that money in your portfolio. So, to that end, let's head down to the NASDAQ in Times Square, where Yahoo Finance's Ali Canal is stationed. Ali, I heard all the applause by you. I guess they're cheering the rise in copper prices.
Maybe, or maybe it's a rise in the stock market. We're seeing gains across the screen here, which is a bit of a rebound from what we've seen the past few days. But this does come as President Trump said he will be imposing a 50% tariff on copper. That sent prices soaring to record levels following that news. We finished the trading day up around 10% when it comes to those prices. We are down slightly off of those highs in early morning trade. But I also want to check in on some of those U.S. mining companies like Freeport, for example. This company is based in Arizona. That's where the bulk of U.S. mining is done when we think about copper. And we're seeing shares rise about 1% there. Not really a surprise, since higher copper prices, that would mean higher revenue and higher margins for a lot of these companies. Southern Copper, meanwhile, saw shares dip a little bit on this news, but the stock had been up around 10% on the month heading into yesterday's close, and we're mostly unchanged here at the open, looking like we're down around 1%. And then finally, I want to take a look at home builders. Haven't been reacting too much. We've seen shares of Lennar, D.R. Horton, Toll Brothers, and KB Home all ending Tuesday's trading session in the green. And as you can see, we are all up in early morning trade, and that's an interesting move considering copper goes into a lot of the homes that we've built. We've seen a negative home builder sentiment over the past few months as economic uncertainty has kept consumers a bit more cautious. We'll see if these higher prices will spook any of investors there. And then finally, let's take a look at Apple, because we are seeing shares dip slightly after White House trade advisor Peter Navarro said that the tech giant thinks it's, quote, too big to tariff. So these were comments that Navarro made while speaking on Fox Business, basically suggesting that Apple thinks it might be receiving special treatment in these trade talks. And as we know, Apple is particularly vulnerable to many of these tariffs, particularly in China. Navarro did add that markets should view trade letters as part of broader negotiations. And I think that's key here, Brian. We've seen the taco trade alive and well within this market. We know that Trump could pivot really quickly. So it's something that, perspective is everything here when it comes to these markets and the comments that the president makes.
Always good to have perspective in life. Ali, thanks so much. All right, let's fire up your daily guide to the biggest market drivers of the trading day. Here's what I'm watching. Number one, President Trump's off-the-cuff move to slap copper imports with a 50% tariff should remind investors of one key thing. That is, in this administration, you must always brace for surprises, and possibly surprises that could have negative economic implications. Number two, the apprentice-style battle to be President Trump's Fed chair pick is heating up, according to the Wall Street Journal. Two of the top candidates, while certainly qualified, could ratchet up concern on Wall Street of a non-independent Federal Reserve if they are in fact selected. And number three, Meta's Mark Zuckerberg is having quite the summer. He's out there poaching top AI talent with big paychecks. On July 4th, he posted a video of him surfing in an eagle costume on Insta. And now he's plunking down a reported $3.5 billion to secure a hardware future. We'll have all of those details. Here to break it all down, I have Victoria Fernandez, Crossmark Global Investments Chief Market Strategist, Keith Lerner, friend of the show, Truist Co-Chief Investment Officer and Chief Market Strategist, and Ali Canal, Senior Reporter, is back. Victoria, good to see you. I haven't seen you in a bit. I'll start with you here. We were talking about the jump in copper prices here off President Trump slapping tariff imports with the 50% tariff. Are you worried that more negative economic surprises are coming, and this market is going to be forced to react to them?
Well, I think we have to wait and see what a lot of these sector tariffs are going to look at. And I think that's what people could be concerned about. So we know we have the pharmaceutical ones coming, we have the semis. There's different areas where they're looking at adding these additional tariffs like they're doing on copper. And we can see some volatility in the market coming from that is sector specific. So I do think there is some concern that we could have some more ups and downs according to what headlines come out of this administration. But again, it all comes back to kind of what we've seen over the past few days. We just don't know what the final element is going to look like. There's lots of negotiations that go on. There's lots of changes that are made to it over time. And so you could see a little bit of volatility, but I think a permanent move up or down in the trend line is going to take some time until we get some more clarity.
Keith, I just spoke to you, and the last time we talked, you were in I think a good mood. You're always in a good mood, but you were feeling good about the markets. Does news like this make you think, all right, maybe the markets will end higher, but at least in the near term, the market has to adjust for potential surprises like this? We're about to get a lot of June inflation data, for example, in about a week or two, and that might be more inflationary than people expect or that the market is positioned for.
Yeah, well, Brian, it's always great to be with you and the team here. So I think it's just a reminder that, markets don't move in a straight line and that we'll get some hiccups along the way. But I also think it's a reminder from what's happened this year is, for a couple of months, tariffs were the only thing that seemed to matter. What we learned during the earnings season and part of the market's rebound is the other T, technology. And, even if you look at the tape today, you're seeing technology continue to reassert its leadership. And the earning trends for tech, communications, tech plus is, a big part of the overall market, right? Those sectors are 45% plus. So again, I think we have to be braced that it's not going to be just a smooth ride. Our outlook this year was a bull in a china shop. Some things got broken in the first half. We expect some more glass to be broken in the second half. But it's not the only thing that matters. And, also the big picture too, Brian, is, a lot of people have been caught off side. So we're also seeing this repositioning that I don't think is fully done yet as well. So I think the market has earned the benefit of the doubt. The uptrend is intact. Do expect some hiccups along the way, but I would not fight the underlying tape, which is still positive at this point.
Victoria, let me get back to you. I heard Keith mention tech names. It's unclear to me if NVIDIA uses copper. I'm sure it does in some capacity. But at the end of the day, is the Mag 7 still the best place you can be in a world where the market might open, we have no tariff headlines, the market closes, we suddenly have something that is now being imported and tariff 50%?
Yeah, I don't know if I would say it's the very best place to be. I do think you have to kind of take a step back and say, are there other opportunities within the tech space where maybe you can get involved in AI but not pay the same multiple that you're paying for some of the Mag 7 stocks? Now, granted, those valuations have come down from where they were previously, and we did get some upgrades. Microsoft was upgraded today, and so there's a good benefit for that stock to see that move higher. So I think you want some exposure to those names, but I do think because breadth is better, we're looking now at about 80% of the S&P names above their 50-day moving average. You're seeing the advanced decline line do better. So because that breadth is coming into play, I think you can spread out a little bit, find some other areas within tech and other areas within the market that perhaps you get a little bit of a better buy, and you can put that into your portfolio along with some of the Mag 7 names.
Allie, amazing. Last word to you. Amazing. And this market isn't taking a hit on this news. I think, at least.
Yeah, and I agree. I think, again, we've been talking about the taco trade markets, largely looking through a lot of this volatility. But as you were just hearing from our panel, strategists have been telling me that you want to stay focused on those high quality names, those high growth names. And the Mag 7 has done incredibly well so far this year. Now, that being said, I will say that there is some selective stock picking within the Mag 7. So Amazon and Apple, for example, have not done so hot year to date compared to Meta, Microsoft, NVIDIA. And on a sector basis, we have seen this broadening out of the rally. So that's potentially some places to look at when you think about hedging amid a lot of this volatility. But I think as an investor, if you missed out on those 2 years of back-to-back gains that we saw concentrated in tech, you want to make sure you're as exposed as possible to this part of the market. And with those strong balance sheets, those cash flows, they can weather a lot of this storm.
Number 2 on my list, and who's not missing out, is Kevin Warsh and Kevin Hassert in getting their FaceTime with President Trump for potential Fed chief. Keith, over to you, and I want to dust off my CFA textbooks and maybe yours as well. If we get this mouthpiece from the Trump administration to lead the Fed, whether it's Hassert or Warsh, I mean, longtime supporters of the president, if that independence is questioned, what does that mean to the longer-term outlook for interest rates? Some folks that I've started to talk to on this would suggest the market has to price in higher interest rates because the Fed wouldn't be perceived as independent.
Well, that could potentially be an outcome of this, but I also would zoom out a little bit and say if we put someone in there that's really friendly towards the president, it's still one person. Now, the Fed historically has been a consensus-building body, but if other members who are on the board today don't agree, they can vote against the chairman. Now, that hasn't been the norm the last 20 or 30 years, but it can be. So I would just say that even if you put that person in, it's not a lock that we're going to move interest rates where President Trump wants them to go. Now, they can certainly influence being the chair, but to your more direct question, if there's a feeling that the Fed is not being objective, then what you would normally expect is you would expect the uncertainty premium to rise. So, right, that would by itself mean higher rates. And investors also become a little bit more concerned about the inflation. So inflation is somewhat less anchored. You put that together, and you would expect that interest rates would be somewhat higher. If based on that one factor alone. But again, I'd reiterate, they're not the only member. Their vote is not the only one that counts.
Victoria, devil's advocate here. Wouldn't it be good for investors to get a Trump-friendly person in the Fed, cut rates, stocks go to the moon?
Well, I think it would be good if you get the rest of the committee to go along with that person. And it actually puts, if it is one of the Kevins, it actually puts them in a very difficult position as a shadow Fed president, because then they're going to have to come out and speak against what the Fed is doing at this point in time. And I would think the other members of the FOMC and other members of the Fed would not like to have that happen. And there's going to be a little bit of tension there if one of the Kevins does come in and take over. So it's setting it up for maybe a little bit more contentious conversations, perhaps, at the FOMC going forward. And that doesn't necessarily mean, as Kevin mentioned, it does not necessarily mean that they are going to be able to lower rates.
And number 3 on my list is Meta reportedly taking or spending $3.5 billion to invest in EssilorLuxottica. Companies already have worked closely on 2 pairs of Ray-Ban glasses. Ali, what doesn't amaze me that Meta will spend this amount of money to get access to a company like this, very interesting company, Luxottica, but is that they are willing to spend even more money on hardware that has never made money. Just go back to the first quarter. They lost $4.2 billion in their Reality Labs business. It's never been profitable. And now they're throwing more money or more good money after bad money.
Yeah, Zuckerberg seems to like taking these chances. You mentioned Reality Labs, which obviously was a big money bleeder for the company. You also had the metaverse, which didn't quite work out in the way that Zuckerberg had hoped. But we knew entering into this year that Meta wanted to spend aggressively, especially as it relates to anything related to AI. They've been spending to attract some of the top talent, lure some of those talent folks away from competitors like OpenAI. And this is something that Mark Zuckerberg said is imperative in order to be a leader in this space. He said 2025 is going to be a very crucial year for artificial intelligence. So whatever ways possible to get there and really take advantage of everything this company is going to do. And they're at a really good point when it comes to its stock price. It's been on a tear since the start of the year. So it seems like investors, they haven't punished Zuckerberg too much for spending this cash. But like you were saying, I mean, if history is any indication, we know that's coming if some of these ventures don't pan out.
Victoria, is Meta still one of the best places you can be in large cap tech? At the end of the day, there are no tariffs for anything that Meta sells. I mean, of course, they're selling the goggles that might have various components from tariffed countries, but by and large, this is not Apple. And if you pull up a chart on Yahoo Finance, Meta has really rallied here year to date, up close to 40%. Apple is down in large part because of exposure to India, China, and other places.
Yeah, you're right. Their tariff exposure is minimal. I mean, the goggle thing kind of freaks me out a little bit. I don't know why people want to wear those.
They're too heavy, Victoria. They're too heavy, and they run out of charge really quick, and nobody's staying at home using those things.
I don't want someone looking at me and I don't realize
right
it.
On.
But anyway, but I think Meta, from a fundamental perspective, is a good place to be because of what you're saying. And look, they continue every quarter to prove themselves when it comes to earnings. And so I think it's a good name to have in your portfolio, especially as we were talking about those Mag 7 and that tech exposure that you want to have.
I will not be buying a pair of Ray-Bans on Amazon Prime Week. All right, everyone stay right there. Before we head to break, some breaking news. Let's check in on shares of NVIDIA, a favorite ticker on the Yahoo Finance platform, as the company hits a $4 trillion valuation or market cap for the first time ever. Interesting company, of course, all things NVIDIA. That is a big valuation ahead of a quarter for the company that has to be really good. NVIDIA now priced for perfection, but keep in mind their last quarter was not good and the market didn't like it initially. We'll have more on all this and other topics on Opening Bid. Welcome back to Opening Bid. I have some more details on KeyBank's cautious comments on the telecom space out today. KeyBank analyst Brandon Nispel cutting his rating on T-Mobile to underweight, the equivalent of a sell, voicing concerns about valuation. While he stayed sector weight or neutral on Verizon and AT&T, he's worried about how increased competition for subscribers will shape earnings for the sector for the rest of the year. I have a little more comments on this on the Yahoo Finance live blog on our homepage, so check them out. All right, now on to our stock of the day, and that is Uber. The no tax on tips provision of the big, beautiful bill includes 1099 workers such as Uber and Lyft drivers in the deduction, according to new research out of B of A. Federal income tax savings will be available even for those who don't itemize, with a max deduction of $25,000. B of A estimates that U.S. Uber drivers will earn $42 billion this year. In crunching the numbers, B of A found that Uber drivers will have $1 billion in tax savings. That equates to a 2.5% pay bump. B of A thinks the tax could provide a modest tailwind to the supply of Uber drivers, therefore benefiting the business in its battle for market share. I am seeing you over there, Lyft. Combined with research showing the number of Uber rides having accelerated this summer, B of A thinks Uber's stock can climb at least 18% from current price levels. I will note, though, that Uber's stock has come a long way, up 37% in the past year. You can see how the stock is priced for perfection when studying its multiples on the Yahoo Finance platform. Shares trade on a forward P ratio of 35 times compared to 22 times for the S&P 500. The price to earnings growth ratio of 15.8 times is miles away from the 1 times often viewed as a reasonable level for a stock. Still with me, my roundtable, Victoria Fernandez, Keith Lerner, and Ali Cannell. Keith, I know you like my PEG ratio shout out. I know you dig that. Victoria, I'm sure you dig it too. But Victoria, I'm going to go over to you first. The rise in Uber has been absolutely brilliant. And a part of that, of course, is probably because Lyft has really struggled here. Is a bet on Uber right now a bet that the economy will stay okay for the rest of the year?
Well, I think you have to assume that if Uber is going to continue to do well like it has been, we're going to have to see an economy that continues to grow. You're going to have a consumer that wants to continue to spend. But it's not just based on that. We have to see Uber as a company make more of these partnerships and things that they've been doing in order to help expand their business, right? They started off with just the rideshare. They added, the Uber Eats. We added alcohol delivery, grocery delivery. Now you have to see how you can bring in autonomous vehicles and have that on your platform. And they've started doing that, right? They have with the Move manager of Waymo. They are looking at buying the American arm of a Chinese self-driving car company. So they're looking to expand that way. And I think that's going to be the key to Uber's growth. But you're going to have to see a consumer that is still willing to spend.
Keith, when I look at Uber stock, you heard me talk about the valuations there. I see it as a growth stock, or at the bare minimum price as a growth stock. At what point does the market go back to value? When is someone starting to get excited about a stock priced at 14 times forward earnings?
No, it's a fair point. I think right now, in order to see that rotation, you need to have more confidence of some type of economic reacceleration. That's normally when small caps do better, when value does better. And maybe you're starting to see, we're starting to see a little bit of that catch-up trade. You're starting to see that a little bit. But at the end of the day right now, I think part of the reason why Uber and technology and communication services have been outperforming this year, if you break down the earning estimates for these growth sectors, they're outperforming, including on Uber. Again, I can't speak to its valuations or if it's fairly valued here or not, but the one thing you can see even with that stock, their earning estimates coming into the year are now 30% higher than what was expected. So that's, for growth investors, what they want to see is they want to see that earnings momentum continue. And in order for them to switch to things like value, they're going to have more confidence that the economy will reaccelerate and that we're past the worst of the uncertainty.
Ali, 15 seconds, last word to you. Are you getting in on autonomous Uber or Lyft?
I mean, I do agree that autonomous driving seems to be the future for a lot of these car companies, including Uber. But I'm a Lyft girl. I think they are cheaper than Uber, especially here in New York City. And like we were just discussing, valuation a little bit too high for me for Uber.
Ooh, I'm digging it. All right, it's time now for our question of the day. And here it is. Where in the world have all the dividends gone? I'm definitely not singing that song. I think it's from the mid to late 90s. Whatever it is, I'm not singing it. Get this stat from Deutsche Bank. S&P 500 dividend yields are now within just 20 basis points of their all-time low, last reached during the tech bubble in 2000. Victoria, why don't investors care about dividends anymore? I mean, this is supposed to be a predictable stream of income. Comes to you, what, every quarter? You could just reinvest it, and you get rich in 30 years.
Well, I don't know, because Brian, I do care about dividends, and I like to see dividends on the stocks in our portfolios. And so I think investors should be paying attention to this. It helps provide a little bit of a buffer to the volatility that you see in the marketplace. It gives you a little extra income and cash flow coming in. So I like to see a dividend, but I do think a lot of corporations now are saying, wait, we can do buybacks instead of dividends. It's more discretionary. It gives corporations a little more leeway in what they're doing, and they can use the cash that they were going to pay dividends to perhaps do other things like acquisitions, invest back in the company in other ways. So I think they're kind of selling it to investors as there are better ways to put our money to work than just giving a dividend. We're going to do something instead that's going to provide growth in the future. I think that's the setup, but I still like to see a dividend on my stocks.
Oh, good point. I think I will go off the rails if I express my hatred for stock buybacks. I can't stand them. But Victoria, real quick, do you have a favorite dividend stock or two?
I do. If you're going to play a stock just for dividend, I think you look at Verizon. You've got something at a very reasonable valuation of 10 times. You've got over a 6% dividend in a company that's paying down debt, increasing cash flow. They're looking to buy Frontier Communications next year, which increases their broadband subscription. So I think Verizon's a great dividend stock for your portfolio.
Keith, is someone crunching the number on the S&P 500, looking at corporate earnings, cash flows? How important is it that companies are paying higher dividends when you come out with certain calls for the market?
It's not the main driver. The reality is we are likely to see an all-time payout this year, even though that dividend yield is lower. But I think part of this is structural too, Brian. If you look at the overall composition of the market, as I mentioned earlier, 45% plus is tech and growth sectors, and those tend to be lower dividend sectors. And then you look at historically, what have been some of the larger dividend sectors? They've had some challenges. The energy sector, pharmaceuticals, utilities is a little bit different, but then real estate as well. So I think that's part of it. As Victoria mentioned, it also gives, by not doing the dividend, which enforces discipline because you don't want to cut that, by going buybacks, companies have more discretion as well. I agree with Victoria, though. The dividend, having that discipline is healthy, but it makes sense to me that the market composition has shifted so much. And it's not the key driver in our view, especially when you have a dominant theme, which is AI driven, and you're seeing a lot more capital spending from these big mega caps as opposed to the dividends. One last point, Brian. I do think we're going to start to see a big pickup in the second half, especially in financials with some of the deregulation past the stress test.
Allie, where are the special dividends from Palantir and NVIDIA?
Wouldn't that be
Victoria
great,
thinks
Brian?
I'm crazy.
Victoria,
yeah, it's okay, Victoria. It's all right. We'll take it offline. It's cool. Go ahead, Allie. Go ahead.
No, but I totally agree with everyone's points here, right? I think we're in a high growth market. Retail trader is really leading the charge. And, those companies just don't have the dividends like some of these more value plays.
I should know, Keith already knows I am crazy. I have known him for many years. Victoria Fernandez, Keith Lerner, Allie Canal, good to see you all. Thanks for so much for joining Opening Bid. We appreciate it. All right, coming up, Yahoo Finance's Market Catalyst. We bring you the news behind the market moves for the trading day. You won't want to miss it.